So our next speaker needs no introduction. Everyone knows our MSRE Program Director and Professor, Dr. David Ling.
So I know what some of you are thinking. I do. You're thinking, had I looked more closely at the program, I would have seen that Professor Ling was the first speaker and I could have got another hour of sleep. So you had to do your homework. Tim asked me for several weeks to prepare some questions for the phone folding thing. And I know I've got some current and former students. What's my attitude with phones being out during class? Just doesn't happen. So I couldn't quite get used to the idea that there'd be phones out in front of me. So Tim was aware of some work that I've been doing with some colleagues that over the past couple of years, a couple of projects that we've been working on, and they center around location. And Tim thought that some of the work we've been doing, kind of in an academic vein, but has some, I think, and hopefully you'll agree, some sort of real-world applications. So he asked me if I'd be willing to kind of share some of this recent research. None of this has been published yet. All of it's kind of in the process. And as you'll see, I do have some kind of strong feelings about location, and I'm going to respectfully disagree with some of the panelists yesterday, and I think I can bring some data to bear to sort of back up some of our assertions. So there's sort of two loose titles. Does MSA location matter as much as you think? And then kind of related to that, can winning MSAs be predicted by the experts? Okay, so I'm going to go back to the age-old adage in real estate that the three most important things in real estate are location, location, location. And I always took that adage to mean that the value of location is priced, right? Everyone understands, buyers, sellers understand the attributes of a particular location, whether it's a parcel, whether it's a developed property, right? And if a location has favorable attributes, you don't get those attributes for free, right? You have to pay for them. We usually talk in terms of paying for them you pay for them by accepting a lower going-in cap rate. And so one of the things I think, or one of the places that I've seen over the years that I think the focus is interesting is on the so-called gateway cities. And these cities came up again several times in conversation yesterday, right? So in my opinion, the profession's been obsessed, a little less in recent years, but obsessed with these gateway cities. You know, New York, Boston, D.C., Chicago, San Francisco, and L.A. I was interested to hear that one of the panelists talked about Dallas as kind of a now maybe sort of a gateway prime market. And one of the things I've heard for years, and I'm sure you have too, when a portfolio manager is investor describing his or her investment strategy, they say frequently, we only invest in supply-constrained markets. But again, the purported advantages of these gateway cities are not free, right? Yes, they're supply-constrained, many of them, maybe not Chicago so much, right? Yes, that's a nice attribute, right? You're more certain about the supply coming online after you acquire the property. But again, the point is you have to pay for that up front. So this was actually kind of a quote from someone who came to campus about 18 months ago. I think he's the CEO of a prominent, well, I know he's a prominent REIT. I think he was the CEO at the time. And he was describing his investment strategy to the students and to the faculty. And he was talking about selling apartments in, say, Raleigh at a 7 cap and buying apartments in New Jersey at a 4.5 cap. And kind of went on to describe that as being a really great investment strategy. And, you know, I didn't say anything in front of the students, but later on at dinner, you know, I sort of pressed him a little bit about that. And the thing, I'm gonna make you walk, I've got two equations. I'm a college professor, so I get two equations, right? So work with me. This is the first one. Okay, so I'm gonna take a few minutes to lay this out. So if you think about your total return when you're acquiring a property, that total return there is my little r. Think of that as your unlevered, going in, required internal rate of return. And you're going to get that return from two sources. You're either going to get it from current yield, right? In real estate, we call that current yield the cap rate. and or you're going to get that return from appreciation in the rent growth, and price growth, right? That total return's got to come from two places, right? So think about the guy in Raleigh, right? And let's assume that in Raleigh at that point in time, that unlevered required rates of return were, say, 9%. I think that at the time was about reasonable for the kind of property. And that unlevered required rates of return in sort of the New York, New Jersey area were 8.5%. A little lower because a less risky MSA. Okay, so in Raleigh, where do you get your 9% return? Well, at that point in time, if you're getting 7% from current yield, the cap rate, you only need 2% growth in rent. Now, this formula only exactly applies if rents grow at a constant rate, but it's a good approximation of where the return comes from. But what about the strategy in New Jersey, right? So you need an 8.5% unlevered total return. You're getting 4.5% cap, current yield. That means rents are going to have to grow 4% over that holding period, right? Double, at this point in time, okay, double the rent growth that would be required to earn a competitive rate of return in Raleigh, right? And so my view, the thing I've always been curious about over these last few years is listening to this conversation about how great these supply-constrained markets are, and I'm not quite sure that it's fully understood just how much extra rental growth you need, right, to make that work. Right, so that's one of the things that got us thinking about this project. So, my view is you should not expect higher total returns when you invest in gateway cities. And in fact, right, to the extent that those markets are perceived to be less risky, you should expect a lower, like in equilibrium, as economists like to say, right? Less risky projects earn lower rates of return. So that gateway thing is one of the things that kind of got us going. So, my view is the expected benefits of location are generally priced at acquisition. Now, some of you will tell me, well, you do off-market deals and you find sellers that don't really understand the market value of the property and you can get in there and buy it for less than it's worth. I'm not denying that happens. It does. But generally, it's hard for me to understand why people consistently might think that they can get something for nothing, right? That they can buy something for less than it's worth. Now, you might say, one of the reasons we talk a lot about MSAs and where we should locate and allocate capital is that returns do vary quite a bit by MSA, ex post, looking back. Right? We all know, we can tell different stories about how the Southeast did well, the North, we can tell stories about variations across the U.S. in the returns earned in commercial real estate in those MSAs. What causes that? What causes that is that the relative values that these MSAs change because there's sort of these unexpected shocks to the economies of those MSAs. And it could be a variety of things. Maybe supply restrictions are tightened even further after you acquire in Boston. Or maybe Boeing announces a relocation from, the Seattle area to Atlanta, or maybe this is kind of interesting. Maybe the federal government really will lose some government workers the next couple years, right? If you bought office property in D.C. a year or two ago, not contemplating a Trump administration, that at least says they might cut some government workers. That could have a huge impact on the value of D.C. real estate. But the question is, can any of this variation be predicted? Right. So when we sit around and we listen to panelists talk about, well, we recommend, go in that market, stay in that market. What does that imply? It implies that they think returns in these MSAs are, to some extent, predictable. Otherwise, why do we talk about this MSA versus the other MSA? The industry spends a lot of time focusing on MSA economics. I get an email every day, if not two, inviting me to go to some conference that's going to talk about apartments in the Southeast or office in the Northwest. And so there's all this talk about, is now a good time to buy apartments in Atlanta? Is there too much supply of office space coming online in Houston? Right? We see this all the time. Two recent articles, Globe Street just sent me something last week. What are the 10 hottest industrial markets? And then I saw an article this week about New York apartments. Evidently, in the boroughs at the luxury end, there's now a bit of an excess supply. Rent growth has slowed. prices are softening, right? And so the big discussion is, well, and one consulting firm recommended selling luxury New York apartments. And think about what that means, right? Now, so if you bought New York apartments before the glut came online, this sort of unexpected increase, right, you bought a year or two ago, are you happy or are you sad? I mean, you're sad, right? Because you bought into a market, didn't anticipate this excess supply. But does that mean you should sell now? Because what that implies to me is that you think that the consultant recommending selling doesn't believe that everybody else realizes that there's an excess supply, right? So if that new information has already impacted prices, so what? I mean, it's not clear to me selling is a good idea. So those are some things that get us going. So again, despite, I would argue, intense industry interest in this topic, right? Lots of discussion about MSA level forecast, MSA rent growth, MSA economies. There's really been absolutely no work done on the extent to which the MSA locations of portfolio properties affect risk and return. And there's absolutely no work that's been done on whether portfolio managers in commercial real estate can time entry and exit from these MSAs. And the reason is that we haven't had the data available to us before, right? What we need to do this work in a rigorous way is we need to know where all the portfolio properties are located for a set of portfolio managers. And we need to know how those locations change over time. All right, so my setup is we now have this data. So we've been working on 3 related projects. I'm going to try to quickly summarize the main findings, and I'm going to tell you what I think the implications are of our work. And as I said, feel free to disagree. So the first paper we've been working on has a title, Asset Location, Timing Ability in the Cross-Section of Commercial Real Estate Returns. This is with a co-author of mine, Andy, at UF, and Ben is an ex-PhD student of mine who's now a professor at Villanova. And so this is the first paper to actually quantify the extent to which the location, the MSA location of the underlying properties in a portfolio affect what we call the cross-section of returns. So the question we're trying to answer is how much does the location of the properties in the portfolios drive or explain differences in returns? And then we also do some work on managers' ability to time. Now, why do we use real estate investment trusts, right? Well, because that's where the data are, right? On the private side, we really don't have total return measures, notwithstanding NACREIF, right? The beautiful thing about REITs is that they trade every second, right? So we have total returns that are based on transactions, not some appraised estimate of what's happened to the value of the property. Okay? Recently they hit about $1 trillion in market cap. If you add debt, the REIT industry, I'm talking about equity REITs, control about $1.6 trillion in assets, maybe 15 to 20% of the investable commercial real estate stock. So it's an important sector. SNL is why we're doing this project. SNL is a company that sells data. But here's the thing. With SNL, we now know where each property that each REIT owns, and we know its book value at the beginning of each year. Okay, so for every single REIT, I know where every single property is that they own, and I know what the book value is. And we're going to use that book value to develop these concentrations. Okay, so what we do, I really want you to follow this, because otherwise, you won't even be able to think about whether we're doing here makes sense, right? So we picked the 25 largest MSAs. There's over 360 MSAs. We can't work with 360 MSAs. We picked the 25 largest, right? And what we do is that we create this big database, right? So for every apartment REIT, we know the percentage of their portfolio that is in Atlanta, the percentage of their portfolio that is in Boston, the percentage of their portfolio that is in Chicago, et cetera. And we update those percentages every year, right? So we actually know where the assets are. And why are we interested in this? Because don't we think that the location of the portfolio properties ought to affect returns? right? So that's what we're shooting for. So just a couple of things. The red bars are the percentage of these are equity REITs, percentage of their assets in these top 25 markets. So if you look, I guess, to the far right red bar, you see that 70% of equity REIT assets are in these top 25 markets, right? So, obviously by excluding 340 or so MSAs, we're not missing a lot. And that percentage has grown a little bit over time. If you go back to the early part of our sample, 1996, that percentage was more like 40%. The blue bars tell us what the allocations are to the 6 gateway cities. So about half of those allocations to the major MSAs are in these 6 gateway cities that we talked about. All right, I'm going to make you work really hard for another minute. I want you to understand what we're doing. This is my second equation, right? So what are we trying to do? We're trying to understand whether or not where the properties are located, whether that explains returns. So on the left hand, this is multiple regression, and I'll keep this as simple as I can. On the left-hand side, we know the return for each REIT in each year. So on the left-hand side, in one of our annual cross-sections, maybe we have 140 or maybe 170 returns for equity REITs. Right? So those are returns that vary across those 140, 150, or 170 firms. And then we want to explain those returns. I mean, this might not be something you're interested in doing, but I'm an academic, and this is part of what we do, right? And so how do you explain them? You just don't correlate them with one thing. You've got to correlate them to the things that we know matter, right? So on the right-hand side of this equation, as explanatory variables, are the things that show up in the literature in these regressions. So the size of the firm matters, its liquidity matters, its leverage matters. Okay, so what we're trying to do is say, let's run these regressions. You can think of them as correlations, but they're not really correlations. Okay, and see how much of the variation in REIT returns we can explain. And then let's do what we think is really cool, is that we add these new variables that we have, which are the locations of these properties, and see what that does to our ability to understand returns, right? So we first estimate this regression without any location controls, just with the 5 variables you see up top. I call it the SOS, the same old stuff. Right? This is stuff that appears in the literature. And then we rerun these regressions, controlling for each REIT's percentage allocation to each of the 25 MSAs. So I've got, instead of 5 variables for each REIT each year, I've got another 25 variables off to the right that you can see. Right? Each year, it's the percent of that REIT's portfolio in all of these 25 MSAs. So you're going, wow, that's... You must have a lot of free time on your hand, Ling. That doesn't seem particularly interesting. But what I'm interested in is how much does this increase explanatory power? Right? If location matters, shouldn't controlling for the variation in where these assets are located, shouldn't that help us explain returns? And then I think, especially for my industry friends, are there any particular MSAs that jump out? Right? Are there any particular MSAs that really contribute to positively or negatively to returns, REIT returns, as we say, in the cross-section? So adding those 25 location controls increases our explanatory power from 23% to 35%. Okay, so what I mean by that is that without any of the location stuff, the model explains 23% of the variation in returns, okay, which is pretty standard. Add the location controls, that explanatory power jumps up to 35%. I expected more. I didn't know. No one's ever done this. No one's ever had the data to do this. You think about what more important characteristics of a REIT is there than where its portfolio is located. But in a way, we were a little bit surprised with the sort of statistically significant but not a big increase in explanatory power. And again, this is all based on our 18-year sample, 96 through 2013. And here's the thing that I'm going to use to tell the story as I get to the end, is that the MSAs that improved explanatory power in one year didn't improve explanatory power in other years. Some that had positive association with returns in one year had a negative association with returns in the next year. So I'm going to show you New York. Okay, I'm going to show you New York. And again, I'm really making you work hard. This is just what I do. All right, so this is New York. All right, each of you give me just a couple of minutes, right? So you see year by year a plot of dots. Kind of looks like a scatter shot, right? And then what are those dots? Those dots are the relationship between having an allocation in New York and portfolio returns. So look at that first dot in the bottom right-hand corner. I can't really point to it. I think it's minus 0.1. What does that mean? It means that in 1996, exposures to New York reduced REIT returns. Right? Anything below that zero axis, if you can see it, those dots on the bottom, those were years in which if you had an allocation to New York, and this is all the property types, okay, that reduced your return. Anything above that zero horizontal line, okay, those were years in which exposure to New York increased returns. And what you see is a lot of variation, right? I mean, you see year-to-year variation, right? And we can explain this, right? Maybe the year there's an unexpected positive shock to New York, right? People change their pro formas, expected rents go up, prices go up, right? But then after that, you kind of get some reversion to the mean. So that's a New York graph. If someone to ask you what were the results of investing in New York over this 18-year sample, you can give them this slide. And I think the conclusion of this is, well, it really kind of depends upon what year you're talking about. Right? It really, really varies from year to year. And if you average this stuff out over time, you see very little effect. Okay, so I got one more kind of busy chart. Okay, so I don't know if you can see this. Hopefully you can. These are the 25 MSAs. So work with me on this one too. Let's look at LA. So what I've done is I've counted the number of times. The black bar is the number of times being in LA was a good thing. So in 7 years, if you had exposure to LA, it enhanced returns. The kind of checkerboard thing right next to it, in 11 of those 18 years, being in LA reduced portfolio returns. And if you look across those MSAs, what do you see? Some positive years, some negative years. But on average, these so-called beta coefficients are essentially zero, right? And the other thing I wanted to point out, I like to pick on Detroit. I was born in Detroit. I grew up outside of Detroit. I can pick on Detroit. In many ways, Detroit was and still is a mess, right? But some people say, well, why never allocate scarce capital to Detroit? But if you look at Detroit, in 9 of those 18 years, exposure to Detroit would have increased returns. 9 of those years, exposure to Detroit would have decreased returns. Right? Because it gets back to my original point. When bad news is released about Detroit, it gets reflected in prices. The people who owned prior to the bad news are sad. Values go down. But that doesn't mean that you can't buy into that market once the pricing reflects the bad news and do just fine. Right? So again, one of the themes here is all this stuff is priced. Right? All this stuff is actually priced. So overall results suggest that MSA locations do matter, right? I mean, from year to year, the return on your portfolio is going to be sensitive to where the assets are. But the return enhancing or the return destroying ability of MSAs changes rapidly. Right? So if you've got a 6-year hold, investment hold, an 8-year hold, a 10-year hold, right? What this analysis shows, using real data and doing this in a rigorous way, is that maybe you don't have to worry too much about where you're allocating capital across MSAs. Remember, I'm not talking about within MSA, Rick. I'm talking about MSAs. Giving Rick a hard time because he said he was going to give me a hard time. All right. Would anybody like to ask a question at this point? I mean, does this make some sense? Bob? They're multiple property types, right? So one of the details, I really don't have time to explain, is that we're controlling for differences in property types in all this analysis. Yes, yeah. All that is taken care of, controlled for in this analysis, right? Because property type, obviously stuff varies quite a lot by property type. Good question, but you'll just have to trust me that we got the property thing right. I'm not calling on you, Rick, yet. I told you. I'm going to go to this gentleman here. Well, because what we wanted to do, we wanted to understand how sensitive returns were to exposures to MSAs, right? And so given that, one of the graphs I showed you is that 70% of REIT assets are in these 25 MSAs, right? So if we'd have done the analysis for REITs for which there's very little exposure, right, we wouldn't expect those to have much impact on returns because on average, REITs have very low exposure to those very low exposure MSAs. So what we try to do is get the REITs to which there's the most exposure, right? Because if you can't get any, if exposure to those biggest REITs and biggest MSAs don't affect returns, then exposures to little ones that hardly anybody has exposure to. It's a good question. I get your point. All right, Rick, you get 10 seconds. Go.
Perspective that you didn't add is what did the REITs yield adjust to by being in having a better quality from the world's perspective portfolio versus not having that? Because what you're saying is, yes, yields go down as they trade into more complicated markets. You sell something in Memphis and you buy something in New York. I'm an old REIT person. But by doing that, the market trades us at a lower yield because we own better, from their perspective, quality assets.
Agreed.
So the only thing I would say that you didn't include that would be important is what did the overall REIT trade at as a yield based on the portfolio that they moved from what the world would perceive as a riskier portfolio to a more stable portfolio, being in New York or LA, in those kind of markets.
So I guess I don't understand the question. What would the overall REIT trade?
Because a REIT trades, what happens is, as we move out of Memphis and Nashville and Chattanoogas of the world and buy properties in New York and LA, the marketplace, the stock trades at a lower yield based on that. So what would be interesting to say is, yes, that's true, the cash flow may be less, but my REIT stock has increased because I own I've gone from a B quality bond to an A quality bond. So therefore, my yield is less in the marketplace.
Rick, I used yields as a way to think about, we all talk about cap rates as sort of a pricing metric, right? That's how we talk about pricing. All this analysis, though, is based on the total return at the REIT level. So I'm capturing, I think, exactly what you're suggesting, right? Ultimately, what you care about is total return, right? Yield is nice, right? But ultimately, what matters is the total return. And in these regressions of this analysis, we're capturing exactly that. We're capturing returns at the REIT level. So we're picking up all that stuff. All right, so I had three things I wanted to do. This is the second thing. Can portfolio managers time MSA entry and exit? Again, go back to a lot of the discussions you hear about this market's great, get out of that market, this market's hot, this market's not so hot, right? All this information's out there about the economies of these different MSAs, right? But can anybody actually use any information? Let's say that Rick perceives that there's a pricing imbalance in Nashville, and at this point in time, let's assume Rick works for a REIT. Can't he use that information to increase REIT returns by increasing the REIT's allocation to Nashville, right? So that's what this is about, right? So the whole idea is can REIT managers, and by the way, we're using REIT data because this is the only place where the data exists. I firmly believe that a lot of our conclusions today, right, would apply to real estate private equity, pension fund, foreign investors as well. Right, so the whole idea is using REIT data, if they think returns in an MSA are going to increase, can they increase their exposure to that MSA prior to the increase? Okay, so this is all about timing. So let me spend just a couple of seconds on impediments to market timing, right? We all talk about, even if you came away from this conference and were convinced that you should go to Atlanta, right? Some panelists told you that Atlanta's great, go to Atlanta. Well, there's some impediments to that, right? If some panelist told me today to buy energy stocks, right, I could go up to my room, click and buy energy stocks like in 3 seconds. But if someone tells me to buy Atlanta, well, that process takes time. You got to source deals, you got to negotiate, you got to sign the purchase and sale, you got to do your due diligence, right? It takes time. Okay, even if you're knowledgeable, even if you've got a presence in Atlanta, you can't move that quickly, at least relative to other publicly traded assets. And then the thing that we found in this research is that especially people coming from outside that MSA can have a significant information disadvantage. And so how do REITs overcome that? Well, let's say a REIT decides it wants to go to Atlanta. Well, what I've seen what REITs will do when they move to a new MSA is that they will, first of all, hire some local talent, right? Because they don't understand Atlanta like somebody who's worked in Atlanta does. Sometimes they do joint ventures, right, with local Atlanta talent, right? That's how REITs tend to move into MSAs in order to sort of overcome their information disadvantage. The other thing about moving quickly, trying to get to this great Atlanta MSA, according to some analysts, is that there's fixed cost associated with acquiring local market information and assembling a management team. Right? I have a very uninteresting life, and proof of it is that I don't watch TV, sports a little bit, some news, but what I like to do sometimes at night is I listen to quarterly analyst calls. Right? So each of these REITs are public companies. Right? They once a quarter have to get on the phone or in person with analysts. Many of the analysts younger than even some of our students, many of them who I don't think really know that much about REITs at this point in time. But one of the things you hear all the time is an analyst will pick out and say, hey, REIT X, you've got this property in Indianapolis. You've got no other assets in Indianapolis. You should sell that property. Right? So I think in the REIT management team often agree. So I think there's this idea that you want to have some scale in a market. And I think this is true of private equity. I think it's true of pension funds. I think it's true of foreign capital, right? So even if somebody tells you that some MSA is great, you're generally not going to go there and buy a property. And I think most of you would agree with that. You need some scale. So this all makes it difficult to move on a perceived mispricing if you think that some mispricing is there. So it's difficult for portfolio managers to quickly kind of time these things. All right, so what we do is another sort of complicated regression analysis, which I won't show you, but I hope I can convince you that we're doing this correct in the sense that the way we've set up this statistical analysis is that we're able to measure with data whether REITs have an ability, okay, to shift allocations into markets that subsequently outperform, or to decrease allocations in markets that subsequently underperform. And this is what we do. So green is good, red is bad. So we've got 25 MSAs, and over our sample, REITs exhibit some ability to consistently increase allocations to these MSAs prior to these MSAs performing well or outperforming the other MSAs. Okay, those 8. But what we also find is that the REIT managers as a group market time poorly with respect to these red MSAs. So what I'm saying is that over our 18-year sample, REITs systematically reduced exposures to these MSAs before they performed well. Right? That's bad market timing. And of course, there's another 7 or 8 MSAs left over, okay, for which exposure to them had no impact on returns. All right, so maybe in a third of the MSAs, REITs exhibited some ability to get there first. 8 MSAs, they exhibited the ability to exit the markets before they should have. And in another 7 or 8 MSAs, they didn't show any market timing, positive or negative. So my conclusions, it's pretty hard to conclude that REIT managers have displayed an ability to time up markets. Now, we can have a conversation maybe later about how good the REIT managers are relative to the private guys, but I would think that these conclusions apply to a lot of portfolio properties as well. We did a similar analysis of timing down markets, and we once again find that REITs don't have an ability, or haven't at least displayed an ability as a group to time down markets. Okay, so what we conclude, not a lot of timing abilities. Everyone's really fixated on the gateways, at least that's always been my experience. So let me just mention New York. Okay, the REITs got it wrong in both directions. Okay, red is bad, green is good, right? So REITs tended to lower exposures to New York prior to New York performing well, and they tended to increase their exposures to New York prior to New York performing poorly. Right, so you don't see a lot of green there. You also see some red with respect to Chicago and San Francisco. So what's interesting, I think, with respect to the 6 gateway markets, REITs were bad timers in 3 of them, and not good or bad in the others. And so one of my conclusions, I mean, clearly the ability to time markets in our data is located in the non-gateways. The non-gateways. And this makes sense to me. This makes sense to us. Less foreign capital, less institutional capital, right? I mean, you think about, Tom Arnold, Abu Dhabi Investment Authority is involved in our board. He's got a 120-person real estate team in Abu Dhabi, travels the world, super smart people. They're very focused on New York and other gateways. Same with pension funds, same with a lot of the private equity funds. With that kind of information flow and that kind of liquidity, it makes sense to me that it's going to be hard to find properties that you can buy for less than their worth, right? Less than their true market value in New York City. Right? I mean, do you really think that transactions go off in Manhattan for Manhattan office with all the eyes on Manhattan? My guess is those transactions are always pretty close, if not right on, the consensus opinion of value. Hard to find a deal. But maybe not so much in Indianapolis or some secondary city, certainly even less so in a place like Gainesville. So what our research says is that if you're just doing strategic allocation, right, you remembered from Finance 101 that you have to have a diversified portfolio, right? Well, certainly you need, and that's certainly true, you need to diversify. But if you're trying to be strategic, our work says that you should focus on the smaller markets. And again, I think a few panelists said this yesterday. I'm finally getting the sense that people are going to the top second or whatever Mike said yesterday, referred to Charlotte and Atlanta and others and other cities. So again, in a smaller market, you probably have a greater ability to acquire a property for less than it's worth, right? Because fundamentally, that's what you're trying to do as an investor. So we have some other interesting results. We look at the characteristics of REITs that make them better market timing. Some of these results are not surprising. If a REIT is less financially constrained, lower leverage, right, that REIT's better able to act on and move into a new MSA, right? And so I don't really have time to talk about that too much. But we do actually look at the characteristics of the REITs that make them better or not, or better or not so good at market timing. So, where's Mr. Becker? Can I get 5 of the 10 minutes I lost? 3? Okay. All right, so I hate to do this. I hate to flip through slides because it annoys me. One of the things that we worked on that I find very interesting is this idea as to whether having a local, so-called home bias, a local market concentration, okay, whether or not that impacts returns. So there's this large literature in the finance literature that shows that investors display home bias. They overweight assets that are close to them. We see it in stock investors, we see it in lenders, we see it in managers of mutual funds. So we measure the extent to which REITs exhibit home bias and whether that or not that affects returns. So this graph, I think, is probably not very readable, but I think very interesting. So I want you to look at the first bar on the left. That first bar on the left is LA. Okay, so there's 366 MSAs, something like that. Okay, on average, REITs hold 20% of their portfolio in the MSA in which they are headquartered. Okay, and then the first one there is LA. There's 7 REITs headquartered in LA. Okay, 66% of those portfolios are in LA. All the other REITs that are not headquartered in LA have about a 2% allocation to LA. So the blue bars in those cities are the allocations to that city of REITs that are headquartered in that city. And the orangish things are the allocations to that city from all of the other REITs who are not headquartered. So there's a significant, I was surprised really at the magnitude. There's a significant home bias in the REIT space, right? Large allocations to their home market. And so the first question we ask is, well, how does this affect returns? So maybe just focus on that red box, right? Every year we sort all the REITs into whether or not they have, whether or not they're highly concentrated in their home market, kind of in the middle third or in the lower third. And then we compare returns, compare the returns for those who have a high concentration to those who have a low concentration. That difference is 43 basis points monthly, which is 5.2% annually, right? So in REIT space, REITs that have a high allocation to their home market, where presumably they know more than those who don't reside there, right? Significant outperformance, 5.2% per year relative to those REITs, right, who have little in the way of home bias. And then, of course, you might not say this, but my academic friends, when I'm presenting this, would say, well, but that could be related to other risk factors, right? So I think you all know what an alpha is, right? Managers are supposed to provide investors with alpha, right? And that's return in excess of what could be expected given that portfolio's exposure to other risk factors. So we do that as well. And what we find is that for the REITs that have a high home concentration, we find positive and significant alphas. Right? After controlling for all the other risk factors, and of course, I'm sure my inbox is going to explode with requests to get these papers so you can take a closer look, right? A 4.8% annual excess return, okay? 4.8% annual excess return associated with home bias. All right. I'm going to take 5 minutes because I'm still on time, actually. So here are the implications. So we've done these 3 papers. Here, and I thought about some of this stuff for years. Here's some of my takeaways, and hopefully, 1 or 2 of these will be useful to you. Anything you know about the relative value or attractiveness of an MSA, anything you think you know, is probably already known by other market participants and already reflected in prices. Again, back to that original point I made, it's hard to get something for nothing, right? And yet, yes, maybe there's times when you feel you find a seller who isn't fully aware of the value of the property. That happens. But general, especially in institutional commercial real estate, it's just hard to get something for nothing. Positive, negative shocks to the economies of MSAs do occur, but they're difficult to predict, right? They're just difficult to predict. Difficulties and costs associated with entering new MSAs make it hard to benefit from any perceived mispricing. So let's say today, as we're sitting here today, some positive shock comes out about, pick your MSA, Boston. Okay, so there's some positive news about Boston. It could be anything. Who's going to benefit from that? Who's going to benefit from the positive shock today? Okay, something positive about the Boston economy. It's going to be the existing owners, right? Now, someone could say, "Oh man, just things are better in Boston." Did I say Boston or New York? Prices go up in Boston. Existing owners benefit. Do you really want to be chasing after that good news? Do you really think you can get there before that news is capitalized into prices? Our evidence suggests no. MSAs that outperform in one year frequently underperform in the next year. Do you remember that messy graph of New York I showed you? You know, positive, sometimes it's good to be in New York, sometimes it's bad to be in New York. On average, it kind of doesn't matter, is really what that graph says. Ability to time markets is located or concentrated in non-gateway MSAs. So one takeaway for me is focus on the smaller, certainly non-gateway cities. Superior performance of a portfolio is driven by property selection and management, not by MSA selection. Okay, something I believed in and been saying for a decade or more. Not that any of you should listen to what I say, but I do believe that it's property selection and management of that property once it's acquired, right, that is much more important than how you select your MSAs. Now, three more things. Diversification is a powerful tool, right? If any of you suffered through at least one finance course, Finance 101 teaches you that diversification is the one free lunch in financial economics. And it really is, right? Depending upon how your portfolio is currently allocated, with diversification, you can increase expected returns on that portfolio without increasing risk, or you can decrease without sacrificing expected returns, right? And it's the only free lunch in financial economics I can think of. So diversification is important. You want to have some diversification. But here's the thing where a lot of you will probably disagree. In my view, a naive diversification strategy is going to be as effective as a strategic diversification strategy. So what I'm saying, let's pretend you're a Florida-based investor. You decide you need to diversify at least across the Southeast. So you're looking at Nashville, you're looking at Atlanta, maybe you're looking at Dallas. I guess that's the Southwest, right? And those cities look like they might be good places for you to go. What I would say, what I've learned, flip a coin, right? In other words, unless you know someone or have some connections to those people in those cities where you're thinking about going that have local market knowledge, just flip a coin, right? Get the diversification. Now, when I say flip a coin, I mean flip a coin with respect to the MSA you choose to go to, and then spend your resources and time being very careful about the properties that you select in those MSAs. REIT managers as a group display significant home bias, right? And I think this is a result that maybe is important for the private guys in the room as well. Right? I had a conversation with Andy Hogshead, Collier Company's big apartment owner, primarily in Gainesville, and I've talked to him a number of times about there's this tension, right? I don't know if 80% of Andy's portfolio, Nathan's portfolio is in Gainesville. I mean, that violates everything that we teach the students in Finance 101, right? You've got, Colliers has an undiversified portfolio. But what do they get in exchange for that? They're the market experts. They know Gainesville in the student market in Gainesville, probably arguably better than anybody else, or at least as well as anybody else. So there's that tension between trying to get diversified and giving up your local market knowledge. All right, so this is my last slide, and I'm actually on time, even with a bit of a delay. So this is my take. Investors should focus on property selection, deal execution, and management. As I said, analysis of immediate market area, due diligence and underwriting, bottom-up strategy, et cetera. In terms of, so have you ever heard the term bottom-up versus top-down investment strategy? So a top-down investment strategy, and this is sold by the consultants, is that they'll come in and you'll talk about property type first, and then they'll talk about, well, what MSA should you be in, right? And then finally, after selecting MSAs, then you go to property selection within MSAs. I'm a believer, after 10 years in this latest research, of a bottom-up strategy. You need to be diversified, notwithstanding Collier not being so well diversified. But generally, I think you need to be diversified. You're leaving money on the table if you're not. But the diversification across MSA, in my view, can be relatively naive, right? And so you should focus on a bottom-up strategy, right? You should focus on property selection and management within those markets. And I don't want to, no offense to my friends at CBRE and JLL and RCL Co. and others in the room who make some money providing consulting services to some of you that tell you where you should go, MSA-wise. I'm saying don't spend your money on that.